Hi, it's Scott from the Family Mortgage team. I just wanted to walk you through some tools that we use to assist you in making the most intelligent decision when you go to buy a home. So the software is kind of neat. It allows us to compare, in this case, 4 different options, and we're comparing them over a period of time. I just kind of started with 60 months as a starting point, or 5 years. And we're looking at what kind of savings each of these brings to the table, each of these different scenarios. So I used a simple example of a purchase price of $250,000 with a down payment of 20% or $50,000 to get a loan amount of $200,000. The rate on this particular one is 3.5%. We're calling this at par. So what that means is that you're just paying the standard traditional closing costs without having to pay any points. The closing costs in this scenario are $4,700 because the $50,000 is the down payment. Now the other option would be to go with a 30-year fixed rate and pay a point. Kind of a good rule of thumb is you can get a 1/4% better rate if you pay a point. A point is 1% of the loan amount, or $2,000. So you can see here the closing costs jumped up to $6,700. I always like to show people different options in terms of the amortization period. So this is a 25-year fixed rate period. The loan amount is not, or the interest rate is not any different, so there's no advantage from an interest rate perspective, but it forces you into making a slightly bigger payment, which pays your loan down a little bit quicker. It's almost like making an extra payment every year. You can see this, the closing costs are going to be the same whether you pay points or not pay points. Now, payment-wise, you can see the payment on the 25-year is going to go up somewhere between $104 and $131 over the scenario where you would have paid a point on the 30-year. So this is going to be the cheapest payment because you got the lowest interest rate and you're amortizing it over the longest term. And then you've got a $28 difference between those two 30-year options. But over a 5-year period, you're going to be about $527 better off than if on the 25-year option than on the 30-year lowest interest rate option. Now the other thing I wanted to show you real quick is that you can see the principal that you would pay over that 5-year period, around $20,000 on the 30-year, but you're looking at $27,000 or $28,000 on the 25-year just by making a roughly $100 additional payment. You're paying down over that 5-year period an extra $6,000 or $7,000 in principal. Now if we look at it over a longer period of time, if we go back in here and say, let's say 10 years, if you thought you were really going to be there that long, you can see the 25-year is going to end up being about $2,200 better, and you will have paid the principal down quite a bit more, obviously, because you're paying it down quicker. Now, if you're only there, let's say 3 years, then the 25-year is still going to be a better option, but not by much. There's not a huge difference. It's really over time, really the big advantage on the 25-year is that you're going to be paying down just a little bit quicker. So that always adds up, and it's kind of like a 401k. You just you don't really see it or miss it once you get it set up, and it can pay big dividends later on. So hope that helps. Thank you so much for watching, and hope to be able to serve you soon.